Bam. All right, we're recording. This is the Rags to Riches stream, not Rags to Riches. We're going to give everyone another minute or two. We'll start off at 12:03. We'll get rock and roll. We got Duco, Nikki, Andrea. How's it going? Welcome, welcome. It's a Friday. We're in the middle of July. Market is relatively slow. So it's important to focus on the slower moving stuff, like dividends. So there's three things I want to cover today. And that is going to be the Greeks, for one, because I promised somebody I would. And then the second one is going to be portfolio ratio. And then the next part is going to be the value transformation concept. Okay. Actually, I'll start with that one. Let's start with that one because I feel like that's a little bit more useful. Okay. So we'll give everyone another 57 seconds and we'll get pushing forward. This is also going to be recorded. I'm recording it on my end. I'll upload it afterward and then I'll post the link in the Rags to Riches channel so you guys can all have access to that because we're going to cover a little bit of technical stuff and a lot of psychology stuff. Oh, Duco's got something important to say. What's up, Duco? You hear cat and heat. You shouldn't hear it on my end. He's not upstairs. He decided to leave me alone for the morning, finally. All right, another 20 seconds or so. What's up, Paratha? How's it going? Sailor Brown? Howdy, howdy. Hope you guys had a good week. 97% passive and wheels, 2% speculative, 1% in sat tying is slowed up. Yeah, I'm right there with you, man. Like I said, that's going to be a long-term hold. I know there's some stuff being done. I did my part, and then I passed it on, and that's all I can control, unfortunately. But I'm still holding mine, so we'll see when that decides to get some utility behind it. I think that's what they're trying to build in, is they're going to tokenize usage for something. Last I heard. Bad week for sure. I didn't place a trade. I didn't find a place to trade today, so today was a no trade day. I would say that's a great day then. It is the crappiest day we've had in a long time as far as volume goes, both for small caps and large caps. So I think today is perfectly reasonable to be risk off. There's no need to force stuff. There you go, Duca. I'm doing my part. I remember that guy in Starship Troopers. Putting in a stop loss. Yeah, I mean, you guys are free to remain liquid on that. I think that was emphasized, at least by me it was. I mean, if you don't want to buy and hold long term, you can absolutely just re-enter and contribute to liquidity and circulation. But I'm just choosing to hold it. That's just, I'm invested in it. You know, it's going to be speculator hell. And you're up 70K at one point. Damn. That is a nice profit. And I'm not going to fault anybody for getting in or out of anything as long as they can justify it for themselves. I mean, I keep trying to get Nikki to talk about solipsism on one of her trading psychology streams, but we're not there yet. Money's already gone, so it's just going to sit there. Well, at the very least, when the tokenization element steps in, that should bring value back into that. Or if nothing else, you'll have the token usage. So at least there's that. Like I said, I plan to hold this for 5 to 10 years. So I'm not in any rush to see it blast off. I'd rather the progress be made correctly, even if it takes a while. And I'm just not in control of it. So I'm also not in the meetings for it either. So I can't speculate on what's going on. Yeah, let's focus on that. So first, I want to talk about the transformation process. Okay, so let me draw this out here. Okay, and this is a fundamental concept I want everyone to get. I covered it in a little bit more detail in Nashville, but I want to share it here as well because this is probably one of the most important concepts you can embrace when you're a trader. So this is a portfolio, okay? Your portfolio has two or more types of containers in it. basically that allow you to do stuff, right? So you can deposit cash into a portfolio, and you can have like shares transferred into a portfolio, but generally speaking, most people just use cash, and then they use that cash to buy stuff, right? Oops. So in this, God, I can't draw today, I'm terrible. In this case, right, if we are looking at our brokerage account, most of us start off with cash. Oh, yeah, let me share my screen, my bad. I'm sharing it on the recording. Good enough. You'll just have to watch it again. That's my little hook to get you guys to watch your recordings. So in this case, you know, you can have, I don't know why that corner is all of a sudden out of whack, but that's okay. Hopefully you guys get the idea. Can you see my screen now? I'm going to draw the word shares here. Okay. All right. So when we start off with cash, okay, cash is in a fixed state, meaning that meaning it does not change value overtly. It does, you know, passively change value because of inflation and because of, you know, other stuff that affects the buying power of the dollar, but the dollar itself doesn't change. It's a fixed value element, right? Like I said, a couple weeks ago, I had $71 sitting on my desk. I still have $71 cash just sitting on my desk. I just don't use cash. So that $71 is still, you know, 3 20s, a 10, and a 1. It's not changing because I'm not using it for anything, okay? And the act of using money we call purchasing, or I guess selling stuff and realizing a capital gain or loss. That is a reverse of that same process. So we're transforming the value of this fixed value element into something that has dynamic value. Okay? Does that make sense so far, just as a general concept? Because when we buy shares, the value of the shares is what we receive in exchange for the money. So we're just transforming it into a different form. But it starts off at the same value, roughly. And then once it's in share form, because it's changing value, it's dynamic. And it will continue to change value until you decide to transform it back into fixed form in the form of cash. Does everybody understand that so far? Okay, Dugo says 1. That's awesome. All right, so my job isn't to choose whether or not the value increases or decreases. My job is to choose whether or not I'm in this dynamic state when it's justifiable and there's potential for that value to change in my preferred direction. So if we view this as a bucket, for example, a little bucket with a handle on it, that's a terrible bucket. Horrible design. Whoever built that bucket needs to be fired. We got to put a handle on it. You know, we're just effectively sloshing what's in this bucket back and forth. Okay, over time. That's what we do as traders. We're just turning cash into shares, maybe not all at once. Maybe we keep some of both and it's just splashing around inside that bucket. And the intent here is to get the level of what's in this bucket higher and higher and higher. Okay? Does that make sense to everybody? So we have this magic bucket where if we slosh things around in just the right way, the amount of stuff in that bucket can increase. So it's like a cup that replenishes and refills itself. But we have to do it a certain way in order for that to be reliable, right? And that certain way is going to depend entirely on you and your execution and the market conditions and all kinds of other factors. And that's what we call trading a strategy, right? So if you start sloshing that bucket around and you just whip it around and then you jerk it back violently this way, you know, stuff's going to splash out of that bucket and you're just going to lose money. If you start punching holes in the bucket, you know, stuff's going to flow out there. It's just not going to be a good time, right? So we have to have a good container, which in this case is a portfolio in this analogy here, but we have to have a good system, and that system has to be calibrated to the bucket. We have to make sure that, you know, we're not giving things enough inertia to get over the side of that bucket just because we're sloshing it around very rapidly. Yes, helicopter style. But I really want to focus on the process of transforming things from one state to another, okay, and then from that state back, because that's your job as a trader. So with that in mind, you don't have to be worried about whether or not something's going to go up when you get in. You're just finding opportunities that have high or low potential and combining that with high or low risk in order to potentially increase the value that you have overall, right? So the overall weight of the bucket, I guess, the mass that's in there. Now, we do this already, okay? And we do it when we buy candy bars at a store, right? We understand that when we have cash and we buy a candy bar, okay, we're exchanging something for something else of equal purchasing power in the moment, and that candy bar also has a value of a different type that we need to transform at some point, right? There's a couple things that we can do, right? We can leave the candy bar out on the sidewalk in the middle of summer. It can melt, ants can come, and blah, blah, blah. It will be distributed to the ecosystem, right? Or we can eat the candy bar, convert it to calories and waste, and then we distribute it more directly to the ecosystem through a plumbing system or blah, 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 right? So we're just transforming things from cash to candy to calories and waste to ecosystem. And then we use the stuff in the ecosystem to go out and get more money. Not the same stuff. We use that ecosystem to go out in working and bring money in so that we can keep the cycle going, right? And that's called an economy at the end of the day, because everyone participates that is active, I guess. Either you're a consumer or a producer, right? So when you're building a portfolio, okay, for investments, you have to understand that the money that you put into positions is dynamic at all times. It will remain dynamic until you transform it back into cash. So you have to be okay with the things that you're exposing your dollars to, which is where we look at things like revenue. Is the company making money? We look at their current ratio and things like that. Are they handling their money well? Or do they need to, if an emergency comes up, how well will they be able to navigate it? Do they have free cash flow? Are they able to grow and reward investors? Or are they going to, need to take the dividend first if they run into hardship? And that's what we don't like to see. So part of all that is to really focus in on how this dynamic area of your portfolio is structured. And thank you, Porter. I appreciate you. I messed this up, though. We got an MC Escher stack of shares. So we have to focus on what this is, right? Because it's just an open pool. There's no structure needed. We just have dollars, and it's either money flowing in or money flowing out, right? So this is very easy. And we already talked about the value of having an inverse relationship between fixed position sizing and dynamic results, and dynamic position sizes versus fixed results with the 1% rule, for example, instead of flat buy sizes. We've already talked about that. So let's talk about the investment side, because this is where we need to build that structure out. So if I were, let me just erase all this and we'll just redraw some of it. If I were just looking at the investment side, okay, meaning that we take the, whatever, 70%, 30%, right? We're just going to cancel this, we're just going to cancel out this speculation side. We're not focused on that today. We're just going to be looking at the speculation side, the investment side. I'm trying to do too many things at once here. So if I were to take this segment here, okay, and break it up into a number of blocks, basically, then I would have some sort of structure to work with. So there's 1, 2, 3, 4, 5, 6 now, and then 7, right? They're not equal sizes. Don't crucify me. So what I would need to do then is understand that these are 10% blocks, basically, because if this is 70% and I've got 7 of them, these would be 10% blocks. I don't need to use 10% per position, but I need to at least break it up into some ratio that kind of makes sense, okay? So now what I personally prefer to do is I would have 2 of these allocated as 20% position, okay? And then I would have another one set up at 20%, okay? And I kind of want these two to play off each other in most cases. So in this side, I would want, I would want a growth position, meaning a company that has really strong fundamentals. Maybe they don't pay the best dividend, but I expect that company to grow over the next, 5, 10, 20 years. And then here I would want income. Okay? And the reason I want both is because I don't just want the money to sit there until I'm ready to die. I want to be able to use it, and more importantly, I want something inside of these blocks to make more money while I'm out here making money elsewhere, right? Because I want the, not just the shares to appreciate, that's the end goal. I want income on the passive side so that I can reinvest those funds and build more growth. Okay. Then there's smaller positions here, and this is more for balancing things out. So a lot of portfolios might have some foreign exposure, and that's not Forex. I'm just going to write 4.exp here, but don't get that confused with Forex, which is a currency exchange. So that's not Forex. They might have precious metals. And then there's like new tech, like there's emerging, like AI, for example. You might have some AI or maybe some quantum if you're into that. I'm not personally investing long-term into quantum yet. But you get the idea. There's some things that we need to consider a little bit riskier. So we're using smaller position sizes, but then we also want to have a lot of this just balanced out, and ETFs are a great way to do that. So broad market ETFs are always kind of a gold standard, if you will, when it comes to building a stable portfolio. So if we don't have one of those or two of those in the growth and income section, we should at least have a dedicated section. I'd say maybe like 15%, 15% at the very least. Like most portfolios have like 35 to 50% for a broad market ETF. Broad market ETF. And then, the smaller pieces here, you get like a little 5%. Maybe that's for foreign exposure. And then you've got maybe another 10% here for precious metals. Does that make sense so far? Like the idea here is we're just, your numbers are going to change. Like you don't have to use the same ratio, and I don't encourage you to, because I don't want to feed you guys information that you may disagree with. But I want you to at least see the value in having some sort of structure here, because what we want to do is make sure that the bulk of our money is leaning or pointing towards this growth stuff, because the end goal, remember, is to amass a large net worth, right? And well, let's call it what it is, a TAV, total asset value, because that's what's going to get you a nice fat collateralized line of credit through an S block. And that's why I like Cathy Woods, for example, I talked about this morning. That's why she buys $550 million of something like SpaceX. It's so that she doesn't have it in cash form. She has it in asset form so that she can collateralize the assets and get a securities-backed line of credit at a much lower rate than she would have if she put that money to work in cash form through more short-term assets. So rather than speculating on $550 million, which is difficult, what she's doing is just buying and holding a bunch of stuff, and then she's using that to circumvent having to pay taxes. So she's taking out securities-backed line of credit, and that is tax-free because it's debt. So all you have to pay is interest and then whatever you borrow from principal, and the interest is only applicable to the draw amount. And then it's just a strategy that wealthy people use to circumvent federal taxes on that same amount of money, because she has to continue making money with it. She can't just let $550 million sit there, or it's going to lose a large amount of money because of inflation. The purchasing power is constantly eroding on those dollars. So does that make sense to everybody? Like the end goal here is to just build as big a pile of assets as you can, in my opinion anyway, and then using that as collateralized leverage, not using the cash itself over and over and over again. Okay, we use the cash to speed the process up to amass those assets, but we're not just using cash all the time for every trade we make. Okay, you love the goal. All right, well, we got to get there too, so that's just as important. So if we have 20% of our, and when I say 20%, I'm referring to 20% of the full portfolio, the full, like, let's say we got $10,000, right? 10K. This would be 7K. Like, so this would be 1,000, 1,000, 1,000, 1,000, 1,000, 1,000, 1,000, and then this would comprise 3,000 because it's the speculative side. Okay. So this is irrelevant for today. And that, again, if you don't want, 30% of your contributions going towards speculation, you don't have to, right? If you're not seeing success on that side of it, you don't have to. You could put 90% into investments, 10% in speculation, or 100% and then 0%. It doesn't matter. It's up to you. You're just going to adjust the ratios here based on however you want to split that up. So 20% plus 20% is 40, plus 15 is 55. plus that is 60, plus that is 70%. Does that make sense? Hit 98 and 2. That's great. 98 and 2. I have zero concerns with that, because if you can grow that 2%, that's all you need, right? So now how do we allocate these so that our money is as safe as possible and also productive while we're trying to build both growth and income positions, right? You don't need to lose 30%. Absolutely. So you're preserving capital. And also, I want to clarify something really quick. The difference between money and capital is the productivity of that money. Does that make sense? So if money is sitting in your savings account, it is not capital. If it's in a portfolio of settled cash, it's not capital. It only becomes capital when you use it for a productive purpose, and that's where we call it in investments. It's capital. So if you're just day trading, you just got cash, right? You're not deploying capital to speculative trades unless you're doing it consistently and methodically. And that would be like every dollar you commit. So just a little nuance point, but I just want to make sure that everyone understands the term capital. And the goal is to make our money productive, because that is what provides wealth. It's not just having money, right? You can have a lot of money and still not be wealthy. You can have very little money and be very wealthy, because wealth is the presence of flexibility and the presence of options. So when we can disrupt that cadence between our inflow and our outflow, we are providing wealth. We're creating a gap in us getting money and that money belonging to whoever asks for it first. And that's where we have to structure our finances before we even get into looking at charts and all that stuff. So if we're looking at growth and income, let's look at some examples. Also, we got our guy from earlier. I got to close that out. Let me just go here. And I'll pull up stockanalysis.com. I'll pull up FinViz. And I'll minimize that. Come back over here so I can see this. All right. So if I'm looking for a company, I'm just going to give you guys a really quick crash course. If I'm looking for a company to invest in, let's look at Pfizer. Okay. I might come over here and type it in there as well. I'm going to do a couple very quick things. First thing I'm going to do is just pull up FinViz, and I'm going to look at their current ratio. And I only care that it's above 1. Okay. I don't really care too much about anything else on FinViz here. You can look at headlines. You can look at the investor holdings if you want to. I don't personally care because the FinViz data is not always reliable. So let me just write this all out as well. 1. FinViz, not FinGiz. And I'm just going to look for current ratio above 1, 1.0. Okay. 2. Then I'm going to go to stockanalysis.com. And I'm going to look for revenue on that company. Okay, so I'm going to pull up the financials. And then I'm going to pull up the income statement. Oops. And then I'm just going to look at revenue. Is the company making money, right? I'm giving you guys a crash course in what I look for. We're kind of piggybacking off what we talked about last week. So on stock analysis, if you just put your mouse over some of these terms, if you don't understand them, it'll tell you what it is. Or you guys are always welcome to ask us as well, me and Lee specifically, because we look into all these all the time. But this little graph icon right here, if you just put your mouse over that and hold it there, you don't have to click it, but just put your mouse over it. It'll show you a bar chart. No, Epic, I'm going to do the Greeks after this. I kind of switched the order around a little bit. But this is investment stuff. So you can use the Greeks to build on your investments, especially when it comes to beta hedging. So this revenue is okay. It's positive. We don't want negative revenue. I don't even think it's possible at this point. But negative free cash flow absolutely is. But this is okay. Like, it's stable. It's not declining. It's, you had a big surge here. It's a medical company. It's a pharmaceutical company. Post-COVID, it's always going to have a surge. But it's relatively stable, and 63.32 billion. I think that's good enough to move on to the next part. Now, next item here is going to be free cash flow. Okay. 3. Is the company keeping money? Are they able to use the money that they have to pay off their expenses efficiently and walk away with a net profit, right? So revenue is just money from sales. Free cash flow is what they keep after all the bills and taxes and stuff. So in this case, not ideal, but it's positive. And it's, it's relatively stable as well. Again, post-COVID is going to have a different trajectory for pharmaceutical companies. So this is okay. It's 9.48 billion, which tells me they're keeping about 1/6 of what they make on their revenue. Okay, so about 18%. So not the best, but not a deal breaker by any means. So I like that. It's good enough. It might just tell me where to look if I want to look a little bit deeper and figure out, well, why are their expenses so high? And I already did this, so I'm just going to kind of run through it. Then I'm going to look at the total current assets and compare that to the total current liabilities, and that's the current ratio that we saw over on FinViz. So I just want to make sure that number checks out. So 42, these are millions in this case. You can scroll up here and you can see it right there. So in this case, total current assets is 42.822. Total current liabilities is 34.348. So this is a net positive of about 1.3, 1.4. What was the number over here? 1.25. That's close enough. I'm just doing mental math here. It's positive. It's above 1, so that's good. I got to get rid of that number there as well. Now this is going to be 4. Current assets. Was that total current? Yeah, total current. TCA. Divided by equals current ratio. Right? And you always want to check these with the SEC filings just to make sure that they're accurate. Because we don't want to assume that these are being reported accurately. Then I'm just going to compare the total assets divided by the total liabilities. If that's over 1, 2, that's great. Otherwise, occasionally you'll see a positive current ratio with an inverse total asset to total liability, and that just means that there's a lot of debt obligations on the company. So in this case, it's about 1 to 2. So we've got twice as many assets, which is good. The reason I want a total current current ratio above 1 is total current assets are all the things that they have on hand that they can sell right now if they have to. And total current liabilities are their 12 months of scheduled debt. So that includes things like payroll, loans, interest payments, taxes, anything that is property related that they just have scheduled debt. So accounts receivable, like just all the stuff, right? So in theory, if we took those two numbers, we can formulate a thesis and say, if this company has to close the doors today and they can't get out of any of their scheduled debt for the next 12 months, they would be able to survive for X number of years, which would be the current ratio. So in this case, they would survive for about 15 months in theory, right? Because this is what they've amassed in non-revenue, right? So that's like selling your bike and selling your furniture and things like that. If you had to pay your rent, like, would you be able to survive if you had to sell the stuff that you've bought and amassed in your home? For how long? How many months would you be able to pay your rent in that case? So that's why I look at those numbers, because that shows that the company is able to grow, keep money, and then also expose that money to investors, which are people like you and I. So now we got to decide what type of investment this is, right? Is it an income position or is it a growth position? Okay. So in this case, I look at dividends. I see it's got a 6.85% dividend yield. That's pretty high. Anything above 3.5%, 4%, I consider income. It's quarterly payout, and it's got a growth of 15 years, blah, blah, blah. So basically, I get $1.72 every year, paid out quarterly on a $25.10 stock. So in my opinion, this is automatically an income position, not a growth position, especially because they're only keeping about 1/6 of their profits or their revenue, which means they spend 5/6 of that on expenses. Now, I understand why that is. It's a short-term condition, so I still like Pfizer. But this is telling me how to categorize that. So Pfizer goes right here. P, F, E. Okay. Now, I would pick other companies in different sectors to also fill in the remaining slots. So in this case, I would do O, I would do Maine, I would do Pfizer, I would do maybe Schwab, SCHD. I like that one. And each of those would just follow the same process. So let's do Schwab, SCHD, right? SCHD. Let's do that really quick. Now this is a different, it's an ETF, so it doesn't have the same metrics. So we have to look at some other stuff, but it's the same process. We're just looking, is it financially usable? Is it functional? How is it weighted? So if we look at the weightings here, I can see healthcare, Home Depot, Abbott, like some pretty decent companies. They're all about 4%. Anything below that I don't really care about. Procter & Gamble, Coca-Cola. So this is a very stable, smaller cap equity ETF, right? So it's good for me. There's 103 holdings in it. This has 3.18% dividend yield. over an annual dividend 1.05, and it's paid quarterly. So in this case, this would be a growth in a growth position, right? Because I'm relying on the growth of those underlying companies, and I get a relatively lower payout on a quarterly basis, right? So then let's look at something like O, right? Let's pull up that. That's a Realty Income Corp. So it's a corporation. It's not an ETF. So that tells us we're going to have a current ratio. Current ratio is 1.86. I know you guys probably can't see it on my screen. Current ratio is above 1. That's an automatic pass to the next step. Remember, I've got these steps right here. Okay. Now we look at revenue, free cash flow, that, and then I got to put the dividend part in here. Oh, these are also not on the. These are also not on there. So the this part right here is the financial statement. The financial, what is it called? The balance sheet. I thought I was doing the category these are all in. It's already there, financials. There's also only one sheet. All right. And then this also is on the balance sheet. I only really look at the other stuff if the company has like heavy debt, for example. That's all I really care about. Dividends. And then this is going to be under, not financials, this is going to be under dividends right here. So, okay. And then that's going to be the payout greater than or less than 3.5%. Div growth, etc. Right, and I'll walk you guys through that. So income statement, are they making revenue? Yes. Are they doing good free cash flow? Yeah, it's a little shaky, right? A little shaky. But does that mean that they're going to take it away from investors, or are they going to find that elsewhere? Let's look at the balance sheet. Let's look at that current ratio again, just to confirm. 16:31, 35:17. That is upside down, so that is less than 1. That's why you don't trust FinViz. So I don't like that right now. It's not a deal breaker, but I have to look into their current liabilities and see, well, what is spiked in their debt as of 2024, 2025, their scheduled debt that is saying, do they take out a new line of credit with a higher interest rate? What's the deal there? And overall, they've got enough assets to cover it by 2 to 1, so I'm okay with it so far. But I would want to look at their debt and see what's going on. And it looks like they just have a bunch of debt. So now I can see, are they, I could spend some time and look in all this. I'm not going to because I'm going to run out of time if I do. But something is impacting their ability to keep money, right? They're making money. That's increasing. But they're also taking on more debt, but they're outperforming the debt. So it's not that bad. But I want to look and see what that is to make sure that those lines don't cross. And then they just go negative after, decades of increasing their dividend. So they're going to not want to take money away from the dividend. They're going to try to avoid that at all costs. So I need to just figure out where else that's being offset. So in this case, dividend yield 4.94%. That tells me this is income position, not growth position. They pay out monthly, and they've been growing their dividend for the last 22 years. You can see right here, very good trajectory. The dividend growth overall is declining, which means it's just slowing down how aggressively they increase the dividend amount. But it's very small numbers on this one. I'm not worried about O at all personally, but that tells me this goes in income next to Pfizer. Okay, now let's look at something. Let's look at Maine. I like Maine. All right, current ratio 0.15. Don't like that. Let's look at their financials. Revenue, okay, that's high and stable. It's good enough. Free cash flow is negative, 165 million. Compared to revenue of 525 million, so about a little less than a quarter of their revenue they're having to pay. Total assets is increased. Total liabilities is probably also increased. Okay. Now this one is they don't have the total current assets listed here, and that's okay too. You can see that their debt, if you just look at this trajectory here, their debt is increasing. So maybe this is one that I look into a little bit more, right? Dividend yield 7.76%. That right there tells me I don't touch this if I'm building this portfolio, because I already have my 2 income positions. So I don't need a high dividend payer here. I'm looking for growth. So I wouldn't do this one. Instead, let's grab something like VOO. right? And again, this is an ETF, so it's going to have different metrics. So let's look at the overview. What's the overview look like? Well, first off, I can tell right off the bat, I'm looking for an income position, which means I want this number to not really be super high. And the reason I say that is because when a dividend is paid, that amount comes off of the share price, and then the share has to recover that adjustment in order to be net positive after the adjustment. So if a dividend yield is too high, then the share price can't grow quickly enough between the payouts to outperform that, and then the dividend payouts will just consume the share price, and it'll just go down and down and down, no matter how well the company's doing. So for income positions, I don't want a high dividend yield because I don't want that friction. I just want the shares to grow in their own native form, right? I don't want it to be converted into a cash, okay? So I hope that does that make sense? I'm going to ask you guys, does that make sense as a concept? And then I'll catch up on the chat here. The Greeks matter. They also don't matter, though, so you're kind of right. Do you compare these ratios to the industry average? You can, if you want to. I personally don't, because I don't believe that there's a lot of validity to that in this kind of market. Every company is going to be different. So if you really want to build like a model out and develop like an average ratio and then see which ones are deviating, you certainly could, but it's not really going to mean anything at the end of the day. Because, I mean, compare like a mom and pop store to something like Amazon. You know, they might both be in the same industry, but you've got one number and another number. If you don't weight those numbers with a very complex model, it's going to give you a false metric, and then you're just going to pass on stuff unnecessarily. All right, so in this case, I can see here it's relatively, this is one of the most established ETFs that are out there. It's a large blend. So obviously right at the top is the tech. You got NVIDIA, Apple, Microsoft, Amazon, Google. Those are all very strong companies, and they're heavily weighted in this ETF. The price of this ETF when we first started looking at it on these streams was like 500 something. Now we're up to 685, but that's okay. So let's look at the dividends. Again, 1.07% paid out quarterly. This is a good place to park cash in this scenario. They've been increasing their dividends. Dividend yield has declined over time, and the share value is what we care about. We don't really care about the dividend yield as much. Okay, and that's a tight range. It's like 1.5 to 1.07%. So this tells me this would go over here on the income or the growth side. Does that make sense to everybody? So I've got growth position and I've got income positions. Okay. Now across Schwab and Vanguard, I've already covered every sector in the market because of how they're diversified. Pfizer is a private growth company. O is a private company. They're going to yield more. They're going to give me more income. ETFs are more for growth and stability in most cases. There are income ETFs, but these are more for growth and stability. Okay. Now I need to look for broad market exposure, which tells me, guess what? I could buy stuff like SPY if I want to, or I can get some of the smaller ETFs, or I can go for private companies that, are broad access. Like maybe it's something like Coca-Cola, for example. Now that's a very, they provide soft drinks, but they also do other stuff. But a lot of their revenue, I've got 15% to break that allocation up. So maybe I want to do like one of the sectors that's maybe a little bit lighter weight in Schwab, and I can just add a private company in here. I could do palladium and nuclear metals, for example, or I could do gold, for the precious metals portion of it. Foreign exposure, there's a lot of really good indexes out there. Not indexes, ETFs, right? AVEM, let's take a look. I'll take a look at that. I don't want to focus on these too much because I want to cover the other topics here, but this is a good example. Does everyone understand the process? I'm just looking here to make sure that it passes the sniff test. This is an ETF, so it doesn't have a current ratio. Then I'm looking here for the metrics, right? Just to make sure that the company makes financial sense. And then I'm allocating those into dedicated slots that need to be filled so that the ratio can be maintained. And let me look at AVEM first, and then I'll walk through how the process looks. Okay, so I see increasing share value, which is decent. They pay quarterly. Payout ratio is 29.04%. What's their dividend yield? 1.9%. This tells me this would be a growth position, if anything. Okay, let's look at their holdings. Semiconductors, Samsung. Okay, a lot of foreign exposure. Yeah, these are all pretty good, in my opinion. Now, everything sub 1 here is a little bit less important, but you've got like Baba in here. So these top ones right here are really the ones that I'd be looking for, and I like Taiwan Semiconductor. That's 6.5% weighted into this one, so I like that. Therefore, we can watch this, and we can watch Taiwan Semiconductor and know that every move on Taiwan Semiconductor is going to have an impact on this price. Okay, now let's look at that dividend. So they pay out quarterly, 1.96%. Let's see how often they have to take away. It's a pretty flat dividend. So in this case, this is a stability growth position. So this would be just a place to park our money, but I don't like this negative dividend growth. So I might use a smaller allocation in this one. Does that make sense? This would be more of like a filler ETF for foreign exposure. I think there's better options out there, personally. What's up, Fire? How's it going? So not a bad pick. It's just I would look for better, and then if I can't find better, then yeah, I'd probably grab that one. Just knowing that it's going to be probably flat, flattish. Now, when it comes to the monthly contributions, for example, right? If we're making monthly contributions, let's say we get a 10K account, we're putting, let's say we put 500 in each month, right? That 500 is going to be broken up into 10 little blocks, right? Because we've got 10% columns here, and then this is 3 of them. So let's do $50 here, $50 here, $50 here, 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 and here, and then 150 goes here if we're using a 70-30 split, right? So between these two, 50, I get $100, which is 20% of 500. Now here, for example, this would be 75, and this would be 1250, for example, because these are different ratios. And then this would be $10, or no, it'd be, yeah, $10, $25, sorry. And so on and so forth. So you're maintaining a ratio, and every dollar fits this system. And then, so what do we do, right? So if we're trading Schwab, what's the price for Schwab? It's CHD. It's currently $32.94, so $50 gets me 1 share that first month, right? So if I go back to the cash to trade, so like the fixed to dynamic state bucket, I would authorize $32 and whatever of my $50 to be transformed into a dynamic state in Schwab, okay? And then if I were to do Vanguard, I already know this is $680. $50 does not authorize me to buy 1 share, so I buy 0 shares. It stays in a fixed state, and it doesn't change. It stays $50, okay? Pfizer, same thing. It doesn't, I'd get 2 shares of this, right? 2 shares of Pfizer, and then probably no shares of, I think that's at $60 or something like that, so on and so forth, right? So what do we do with this $50 that's sitting there because I can't afford to buy Vanguard shares if I only have $50, right? I can buy partial shares if I want to, but at the end of the day, I'm just choosing to keep that $50 in one state versus another state so it behaves the way that I want it to, okay? And it might take a few months before I can build up that cash. That little bucket of $50 might add up, 1, 2, 3, 4. Maybe it takes a year of just adding up that cash portion before I can authorize buying 1 share. And the reason I want to do it that way instead of the other way is, let's say I take 1 share of Vanguard, right? On a 10K account, I'm adding in $500 a month. Let's say I don't have any shares yet, and let's say I'm starting fresh at $500 a month. If I buy 1 share of Vanguard, okay, that's $680, okay? And then let's say I buy 1 share of Schwab, okay? And that's about, what was the price on that? It was $33, roughly. Is that a healthy ratio? If I'm putting 20% into both growth and income? Now these two are both in the growth side, so let's kick it over to Pfizer, right? Let's say I do 2 shares of Pfizer. Okay. And that's going to be about $50-ish. Somewhere around there. I'm rounding because it's like 24, 25. Is 680 on the growth side and $50 on the income side? Is that a balanced ratio? And then also, more importantly, where does the deficit come? Like, what am I not buying because I chose to prioritize buying Vanguard in this case? I have to pass on all these other positions because I wanted to put money in here first. And that means that these more efficient positions don't have anything in them. So I'm actually setting myself back by just not sitting on cash. And I don't want to buy other stuff with that cash ahead of time because then I have to sell it within the same year. And then that's just an unnecessary capital gain that I have a 35% tax rate on. And I'm not going to outperform that, you know. So I'm just going to let the cash sit there in that little Vanguard bucket or the Pfizer bucket or the O bucket or the main bucket or the Schwab bucket, whatever it is. I'm just going to let it sit there and it's just going to build over time. And that's all I need to do. I just need to let that water level rise in this cash portion before I remove this wall and let it slosh over to this stuff or vice versa. So that's the goal, is I want to make sure that I'm managing the flow of money in my portfolio more than just picking good stocks and buying a bunch of them. I need to have a strategy here. Does that make sense? Like from start to finish here, we talked about starting with cash, the value of transformation, and the fixed versus dynamic state of our money. And now we're boiling that down into specifics about what to look for, what we like to buy, what positions need to be filled and how they balance against each other in a portfolio, and then how to wait and how to sit on cash until it's justifiable to transform it over into a dynamic state as part of this ratio, this weighting in a portfolio. So if you have 10K, yeah, you can absolutely get some of all these. That's not a big deal. But if you're starting fresh and you've got a smaller amount of money and you can only put 50 into each of these, or should only put 50 into each of these, you don't want to buy a $680 share right off the bat because A, you don't have that in your portfolio yet, and B, you're depriving all these other positions of that potential resource that can be more efficiently used over time. Remember, capital is about productivity. It's not just having money or having assets. It's about how productive your money can be. Does that all make sense so far? I know I'm going over a lot of technical stuff, but I want to make sure this stuff lands well and that's usable so that you guys can actually get some value out of it. So if it does, if you guys don't mind, just put a 1 in the chat. If it doesn't, put a 2 in the chat and maybe a comment about where you got lost, I guess. Or if you're Snowflake, put a 3 in the chat. All right, good stuff. I'm only paying attention to Duco today. Okay, thank you guys. Appreciate that. It's just for my feedback, so I know that I can help you guys absorb this stuff better, because it all makes sense in my head. But I have the task of getting it translated into words, put into drawings, and then having that also recompile in your brains the same way that it exists in mine. So if I can get more efficient at doing that, I will be happy. All right, so I'm going to erase this, and again, this is recorded, so you guys can just rewind it. All right, now. I'm going to also, I'll put this in the chat here for you guys, just so you have it, and I'll also put it in the Rex Riches chat. Let's talk about the Greeks. I think we covered this one really well, and I think we covered this one really well. If you guys have questions about that stuff, feel free to throw it in the chat. And let's talk about the Greeks right now, because the Greeks are simultaneously important and also not important. So let me just get my Webull moved over here. Can you guys see my Webull now? Not happy about the Odysseus. Okay. Fair enough. Your portfolio is the ship of Theseus. You have an MBA and I teach it better than any professor. Well, I hope you can critique some of it, at least. I just want everyone here to be in a better position than they were before I get a hold of them. So if that's landing, I appreciate it, and thank you for the feedback. If there's anything that you see that I'm saying wrong, absolutely call it out. I welcome scrutiny because that helps everybody get better. So I appreciate you sharing that. Not yet? Okay. I like the ominousness of that. You will. All right. So when we're talking about options, okay, we have to understand what they represent. So let me bring up my drawing tool again. So again, there's cash, then there's shares or some other instrument. We're transforming the value, right? So when you buy a contract instead of shares, that also has a little, like a hidden value. Okay, so contracts are options contracts are an agreement that you are entering when you buy it. Okay, and what that agreement says is that you are willing to fulfill a transaction upon demand, or one of you is, whether it's the buyer or the seller. So if you're buying the contract, you are the one that is buying the right to facilitate that transaction. So you're saying, I want to buy your shares, or I want to sell you my shares. It's my control. I'm the one who bought the contract. I decide when this assignment takes place, if at all, right? And if someone sells you a contract, they're saying, all right, well, I'm selling you the right to buy or sell shares to me or to buy my shares from me. But it's at your discretion. You choose when that happens, okay? And if you don't choose and the contract expires, depending on where the contract is and where the stock market price is, you may or may not get automatically assigned. That's on you, right? So in this case, we're just going to look at that from the perspective of the buyer, okay? And when I teach the Greeks, I like to view it as like a permit to like having an event in a city park, right? You've got, let's say, 5 days, right? 1, 2, 3, 4, 5. The proportions are a little jacked up there, sorry. So let's say here's Monday, Tuesday, Wednesday, Thursday, and then Friday, right? So if you buy a contract, or if you buy a permit from the city, and they say, all right, you have 5 days. You can do anything you want in that little section of the park. You can have something or you can have nothing, right? You don't even have to show up to the park that day if you don't want to. That space is yours no matter what. You have the right to that space, okay? And you have to pay 5 days worth of permit cost. You have to pay that premium in order to reserve that space in the park, okay? Or the right to do stuff in the park. So on Monday, it's going to cost you some money, right? Because you're paying a good amount of money for a good amount of time, all right? If you just wanted a Monday to Tuesday permit or just a Monday morning permit, it would be cheaper, but you would lose value faster because those deadlines would arrive sooner, right? So if you pay for a whole week, you're paying for 5 days, it's going to cost more. And that is one of the most important concepts for understanding how contracts are priced, because you're paying for opportunity over time, okay? So let's say we buy all 5 days, and then let's say we don't do anything Monday, Tuesday, Wednesday, all right? The money that we paid is going to be in that dynamic value because the permit will change over time. It's going to become less valuable here if there's nothing going on in that park, right? Or even worse, if there's like muggings or a fire or packs of wild dogs in the park, the value of that permit, if we try to sell it to someone else, is going to be much lower than what we paid, okay? So let's just assume nothing at all is happening in the park. The contract will the permit will naturally just lose value. So if we try to sell it to someone else, they might buy it. They probably will, because maybe they're just looking for an overnight, just a Thursday and a Friday. But they're gonna pay us a lot less than we paid. It's like buying a car and then selling it 5 years later, right? You put some wear and tear on that car, you put some mileage on it, some time goes by, it's just not a new model anymore. You're not gonna be able to sell it for what you paid, okay? It depreciates. So, does that make sense? Like we're just talking about the passage of time versus the time remaining on a contract, or a permit in this case. So our job, our goal when we're trading options, is to look for events happening in that park, or look for there to be a lot of stuff going on in that park, and pay as little as possible for that contract with the hopes of something happening on Monday, something happening on Tuesday, something happening on Thursday, so that we can increase the value of our permit, so that when we sell it to the next person, even though there's less time on it, they're willing to pay more. Does that make sense? It's like a concert ticket, but we really want all kinds of stuff to be happening at that concert. Okay, so that's the goal as a trader, and the way that we navigate the up or down of that price of that permit, or contract in this case, is through the Greeks. Okay, and the Greeks are not something that someone manually calculates. They're not something that someone is just sitting there and punching into a form, and they're called secondary derivatives. And what that means is that when a number has to get to another number, all right, you have to use a formula to translate the process in which it gets there. Okay, now that might sound a little complicated, but basically if I say, x plus 2 equals y, right? We can, well, let's get rid of y. Let's say 5, right? Everybody here, in most cases, can reasonably assume that x would be equal to 3 in this case, because we know we would subtract 2 from both sides here, right? And we would be left with x on one side and 5 minus 2, or 3, on the other side. Does that make sense? So we're isolating the x in this case. Now, when it comes to other more complicated formulas, like theta, for example, which is one of the Greeks, to just plot this time decay, we have to use other variables in between. Like we can't just say t minus n equals 0, right? Because that doesn't accurately calculate what that number would be on Wednesday, Thursday, and Tuesday afternoon, Wednesday at midnight, Thursday at 1 o'clock in the afternoon. It doesn't clarify that. So what these guys did back in the day, there's something called the Black-Scholes model, and that is a very, very complicated formula. I'm sure I can find it if I look on Google. It has a lot of symbols. There are primary Greeks and there are secondary Greeks. I think there's 26 secondary Greek values and there's 5 or 6 primaries, but we don't care about the other one. Sorry, there's 5. But basically what that does is it says we've got these main Greeks, these main values that we want to use in very specific ways, and we want to apply them very specifically to the value of this contract at any given time with a very specific intent of having it equal to the dollar amount of the underlying shares at the expiration of that contract. That's a lot of words, right? So let's break it down. So we've got 5 primary Greeks, okay? We've got delta, okay? We've got gamma. Can't draw today to save my life. We've got vega, and we've got theta. And the 5th one there is rho, but that's tied to the federal interest rate, and we don't really care too much about that unless you're doing leaps, okay? And then rho. Okay, so the first thing I want to do is I want to look at the first letter of each of these, okay? So D is delta. I'm just going to write the word dollar here, okay? And basically what that says is that, let's say I buy a contract of Tesla and it's got a delta of 27 cents, okay? If Tesla's price goes up $1 after I buy that contract, the contract that I bought will increase by 27 cents. Does that make sense? So every dollar move on the underlying stock price will result in 1 delta being added to or subtracted from the value of the contract. And I'll show you actual contracts so we can walk through some examples here. But that is $1 move equals 1 delta applied to the contract. So if I told Docta to go make plates, and every time he makes a plate, I'll pay him 27 cents, and he makes 5 plates, I would give him 5 of those 27-cent payments. Every time he breaks a plate, he owes me 27 cents. Okay? Now, gamma, hang on one second, guys. Sorry, give me 1 moment. I'm back on the recording. Apologies. I had a little personal situation there. I'm gonna have to cut the stream off. I'm sorry. We gotta cut this off. I have a recording for the Greeks. I guess I can share that for you guys. Sorry about that. I just got to go deal with something personal real quick. Yeah, my bad, Jag. Didn't mean to surprise you there. But I'm glad we got through as much as we did. Unfortunately, I got to go deal with this because it's Friday and it's a court thing. So I hate dumping you guys, but I gotta risk manage here. So thank you all for watching the recording. I'm gonna post the link in the Rags to Riches channel. I'll pin that as well, and we'll just pick up where we left off next time.